For the first time, inflation levels in emerging markets are far lower than that in developed markets like the US and the Europe. I'm reading out from a Morgan Stanley report. This means that emerging market central banks don't have to hike rates as much as developed markets. Also, the much feared recession may also be more a developed market problem. Does this mean smart money and serious long-only funds should start increasing allocations to emerging markets, and which markets? For these questions, I have with me someone who has done seminal work in emerging market investments. I have with me Jitania Kandhari, the Deputy CIO of Portfolio Solutions and Multi-Asset Group, Head of Macro Research for Emerging Markets at Morgan Stanley. Jitania, thank you very much, and more importantly for dropping in into our studios. Okay, well, the first question to you is exactly what I set in the theme, and I picked it up from one of your research reports. Is there a greater case for investing in emerging markets?
Yeah, thank you for having me on the show, Lata, firstly. And yes, I do think that we are at the stage of the market and economic cycle for this asset class where investors will increasingly start looking. Of course, it's a very heterogeneous asset class with 24 countries that are part of this index with different macro and political cycles. But at an aggregated level, I'd say three things that really support the case. One is relative performance, two, relative valuations, and three, the fundamentals. So since 1930, if you look at data, we have seen the worst decade in emerging market returns in the last decade. They had their back against the wall post the global financial crisis, and they have spent the last decade reforming, and they always do when they have their back against the wall. Secondly, the relative valuations, they are at 2000 levels when you started a commodity cycle post the 1990s recession, recessions and multiple crises in the asset class. Valuations are extremely compelling. What's more important is currency valuations. Ex-China, the currency valuations are also back to 2000 levels, and currencies contribute a third to emerging market returns. So that is very bullish. And then fundamentals, as you said, inflation in emerging markets is not a demand-led structural problem. Wages are not an issue for inflation like the US. The supply-related issues, which have the food, energy prices, or the supply disruptions, that have caused inflation to peak, now actually peaking in some of these markets. And more importantly, the central banks have been way ahead of the curve. For example, central banks like Brazil have raised rates by 1,100 basis points since 2021, the last quarter, when US was not even talking about tightening. So they've been preemptive. Demand is clearly picking up post the vaccination and the opening up of these economies. And I'd say the four structural drivers are reform momentum, the commodity cycle, which supports some markets, digitization, which is a big growth driver in many emerging markets, and manufacturing because of the supply chain diversion that's happening in the geopolitical world where China is in focus.
Okay. Well, actually, I had some of the graph plates that Kandhari gave me before she came in. And clearly, in terms of valuations, I'm not able to show. It's a rather large chart. But I want the inflation numbers to come up again, and you will get an idea. Brazil and Mexico are still higher in terms of emerging markets, but US 8.5%, Euro area 8.6% inflation compared to a whole host of Asian countries. India, Philippines, South Korea, all of them 6 or below 6%. So clearly that proves the point. Okay, but Jitania, within the emerging market basket, what's the case for India first?
I want to say this, that I'm really very positive on India, again, at a relative level. So I'd say a few things happening. India has never been a manufacturing story, right? It missed the manufacturing bus. When China joined the WTO, China was the manufacturing economy that lifted a lot of the emerging market boats with it. But India has been services driven. That's a large part of the exports. So this time I'm beginning to see some signs of a manufacturing pickup in the supply chain, with the supply chain diversion. I hear it anecdotally in pharmaceuticals, in Apple setting up facilities here, in chemicals, etc. So I'm hoping that the long-awaited manufacturing pickup will happen. Most importantly, I find the credit cycle looking extremely interesting. So if I look at the Indian consumer, I look at the Indian corporate, and if I look at just the whether it's the government, the banking sector, there has been a deleveraging that's happened. So the last 10 years, private credit to GDP in India has actually degrown. In China, that number is 65% up. So credit has grown in excess of GDP by 65%, as an example. There has been a cleanup. Banks look very well capitalized. If I look at real estate developers' balance sheet, gearing is down. The affordability for the consumer is looking extremely compelling, even in the real estate space. Price-income ratios, which is a gauge of affordability across different markets, that's down to 3.2 versus, say, a 6.7, actually one of the lowest in the world.
To the income.
Yeah, relative to the income, average income of an Indian household. So look at a lot of these metrics. I feel at the banking sector level, at the corporate level, and at the consumer level, I find a lot of positive developments that will help initiate a credit cycle. And a credit cycle is always important for a growth cycle to take hold. Demographics, etc., we know are clearly compelling, though the world is on a depopulation, degrowing kind of trend, but relatively, again, India stacks up. So I do, reforms which have been initiated by the Modi government. Once, at one point even we were skeptical, but we're beginning to see the fruits of those reforms, whether it's the unique identification number, how the digital penetration is spreading, and how these reforms are actually supporting the whole momentum on the growth side. So, looking at all of these things, as I mentioned, the reform cycle, the digitization, just the recovery post-pandemic, the credit situation, I have longed to see investment to GDP pick up in India, because again, that is the killer app for growth.
That's not picking up.
And if that picks up, it would be great. But nothing happens in India in a straight line. It's always incremental. And I'm just seeing the delta of that incremental change getting positive.
No, I take your point. We have a lot of debates worrying about the fall in savings to GDP ratio and investment to GDP ratio. But, I was interested in another plate you had about comparing India's real estate sector with the Chinese real estate sector. So two questions here. Do you see the Chinese real estate sector dragging the Chinese economy itself? And can that be a killer reason why money could get diverted from China to India?
Definitely one of the reasons. And I'd say the India versus China real estate sector are two opposite ends of the spectrum. So let's start from the top, right? The share of GDP that's from real estate and ancillary industries, again, this is work done academically, is 25% in China. Huge part of the economy, huge part of the growth of the economy. In India, depending on estimates, it's anywhere between 7 and 9%. So the starting point in terms of the real estate contribution to both the absolute GDP and GDP growth is much more favorable. More interestingly, as I said, the Chinese consumer is stretched. China's credit to GDP has grown overall, but consumer credit has grown up, driven by mortgages. In India, the reverse has happened. Actually, India, in the last 10 years, real estate prices have been flat. Absolutely. As per data that we look at, compared to many other markets. India comes in the lowest with Brazil and some of these other cases. So the starting point in terms of the consumer, in terms the affordability, as I said, price-income ratios, and also on the developer side, Chinese developers are completely clogged. There's a lot of debt. It's sloshing
Evergrande
around.
is not one of them.
It's a lot. It's sloshing around all over, unseen. In India, gearing is down. So if I had to summarize it, on the demand supply, which comes from the consumer, that's much better here. On the supply side, which comes from the suppliers, gearing is much better here. And finally, on the fundamentals, as I said, the credit cycle, the ability to take on a mortgage, the ability to service that mortgage is much, much stronger here.
Okay. So would that be one of the big sectors you would recommend in India, real estate? What would your pecking order be?
Unfortunately, there's not a whole lot to play for big funds like us, but definitely we see pockets of growth. And I think the other sector that could get supported is, of course, banking, financials. But more importantly, it is a sector that leads to construction, leads to employment, leads to job creation in the economy. So it tends to have that impact with a lag. And I think that we are at a point where that could contribute to GDP growth rather than detracting from GDP growth, which has happened in the last decade.
Absolutely. I take your point on that. It was a big problem, say, about 5-6 years ago. But where is India in the pecking order in emerging markets?
So, we really do like India. It's one of our overweight countries for the reasons I've mentioned. Even, politically, we see less issues here. I mean, it's never a straight line up. There are huge political issues in some of the other markets that we track. President Modi's approval is the highest in the world.
Yes.
So it's an interesting thing.
Political stability is a given, yes.
Yes, so India definitely looks good. I do see a lot of opportunity even in other Southeast Asian economies that are...
Indonesia, according to your charts, is doing very well.
Indonesia is doing well. We're also taking a closer look at Thailand, Malaysia, because these are countries that are actually seeing benefits of the supply chain diversion that's happening out of China. Now, it's very anecdotal, but I'm sure we'll start seeing it in numbers. I am seeing export share gains in some of these markets like Indonesia. Vietnam is a big story there, even India, because of all of these little industries springing up. For example, in Bangladesh, it's textiles. In Thailand, it's electronic components and auto parts. In India, we're seeing it, say, in the chemical space. So in Vietnam, again, it's electronics and components. So in different parts of the Southeast Asian continent, we are seeing some of this helping the manufacturing side pick up. Again, like I said, that'll create employment, it'll create jobs, it'll create a consumption story. Yes. We are at the beginning stages. And again, these economies have also not really exceeded their credit absorption, etc. So, but one has to keep in mind they're all sub 2% of the index. And we do like some pockets of the commodity space because we are fundamentally positive on commodities, given all the demand supply issues, especially in metals, not so much in oil. So again, those are countries like South Africa, Brazil, Indonesia also kind of fits in there, where the positive shock from the terms of trade will create a good domestic liquidity cycle and a growth cycle. And all of these markets are finally come out of the COVID issues.
Well, let me pan out and ask you how fund managers think. Now, if China is not a great growth story, and it seems to be, I don't think they will get to their 5.5, which was the given target. If that happens, do the entire EM funds kitty shrink, or will funds make the distinction and stay pro-EM, but ex-China pro-EM? Is that a possibility?
Lots of questions and lots of thinking around this. And I think there will, the question that clients ask, is China investable? Of course it's investable. The question is where and how? And what do you invest in? So it is 30% of the...
But this is the first time they're asking that question, isn't it? Otherwise, China was axiomatically investable.
Right. So there are, we are significantly underweight China, and we're seeing other pockets in our portfolio. There are things to play in China. I call it China 3.0. China 1.0 was 2000, when it was all about manufacturing commodities. China 2.0, which was 2010s, was all about internet, e-commerce. China 3.0 now is all about automation, advanced manufacturing, supply chain diversion, domestic sourcing, semiconductors, and there are a lot of opportunities because China realizes that the only way they can grow is enhancing productivity because population is not growing.
Okay. So no, coming back to our point of view, I mean, we have an Indian viewership. Should we expect that emerging market funds will continue to attract even if China is not a very big, attractive force?
Yes. So
it won't happen that EMs are deserted because China is not doing.
No, because there are many EM ex-China mandates that are being talked about in the market, and also within emerging markets, you really have to be an active country allocator. So you could, emerging market index morphs over time. So in 1980s, I won't let you guess, I'll tell you. Malaysia was 30% of the emerging market index.
Okay.
In 1992, Mexico was 30%. There has been no country that has been able to go above 30%. But the emerging market index still compounded 9%.
So you expect that India can grab a much larger share?
India can grab a much larger share. China reached that peak of 40%, now back to 30%. I think the weight of China in the index has to mean revert downwards, but there will be other players, other markets that will catch up, and therefore being in an emerging market actively managed fund is the way to go.
Okay, well, the larger question that I have to broach, do you see a recession in the West? That is, Europe already is in, US as well. If that happens, does growth in EMs like India continue, or will our growth suffer because of developed market recession?
Yeah, so I'll answer it. First, I'll answer the latter part of your question. Yes, if US sneezes, India will catch a cold. So I do not think India is, immune to it. It's very linked. The second question is, as you pose, what about recession? So I haven't been in the recession camp for the last year, and I think recession for the next year also is a 50-50 possibility. Now, why has recession probability gone up? Because of monetary tightening, fiscal contraction, oil is up, there's an oil crisis, and there's no China and Europe to the rescue. That's the reason. But we need to really dig in below. What is really happening in the US is, though past recessions have been caused by some of these issues, there is no excessive leverage like the global financial crisis. The consumer, the corporates are not in those kind of elevated debt leverage positions. US wages are growing 5-6% depending on the metric you look at. US unemployment is 3.5%. There are wage gains. There will be a slowdown, but there is a lot of internal defenses. And oil prices, yes, they impact the consumer, but they help the producer side of the US economy, where shale is a big part of the economy now. So there are these offsetting balances, and I am not sure if we are 100% getting into a recession. We could soft land. Clearly, growth will slow, like we did in the 1965, 1984, 1994, where we could have a soft landing situation. If the Fed were to get very tight, I'd be more worried.
Running out of time, so I have to ask you my final question, and I'm banking a lot on this.
Okay.
If you got $100 today, how would you allocate it? How much would India get? And 3 years from now or 5 years from now, if you had that $100, where do you think the allocation will be? How will India's allocation be higher?
So you're saying where would I allocate it, in equities or in every asset? In equities.
Everything, okay, everything.
So I definitely own some real assets, because I think inflation is the name of the game. I mean, it's not going to be 8%.
When you say real, you mean commodities and real estate?
Commodities, real estate, private equity. Yeah. We're not going to, inflation's not too...
Okay, let's keep to equities. I think that'll be simpler. Okay. If you have $100, which equity market?
I will definitely invest in emerging markets, because I think US is at a 100-year high in terms of performance. Within emerging markets, I would have India. It's 15% of the index today. I'd own much more than that. Okay. I would own Southeast Asia. I would own some pockets of Latin America. I would own pockets of Europe, because I think it's decimated.
All right. Oh, yes. And 5 years from now, do you think your allocation to India is likely to increase? Do you see enough trends?
Yes, I think, like I said, India is 15%. I think India could demand a greater share of the MSCI EM index as this index morphs. I don't know if it'll go to 30%, but I'm sure the trend is up. There are risks, Lata. If oil goes to 120, India is in trouble. If the government doesn't create jobs for the youth, then you cannot have any growth cycle if there's no good employment and there's a skill mismatch. So those are risks. And India has run up. So we are very conscious
Exactly.
of the fact.
I was going to bring the valuations argument as well.
Yeah, very expensive market. But it's keeping up with, the valuations have gone up with earnings going up.
Growth.
So, and return on equity going up. Now, if that were to change for any reason, there will be a derating. So this is not going to be a straight line up like everything is.
Yes.
We will be up and down, but I think the structural trend is up.
Okay. Regardless of those caveats, I think this is one of the most bullish conversations I've had. We had a lot of conversations on India at 75, but this clearly is ranking as one of the more bullish conversations. More allocations to India, more than the 15% in the index, and likelihood of India claiming more allocations from the emerging markets in the years to come. We have to wrap up on this special segment of Indianomics. Thank you very much for watching. Chartbusters up next.